Hey, y'all, it's Rashida, and today I'm starting a new series about how to get started investing in the stock market for people who aren't already doing it. If you don't know me, my name is Rashida. I go by Shida D online, and I am a career break coach that helps women leave jobs that don't deserve them. A lot of the women I work with have the desire to travel the world, take a career break, maybe retire early. And one of the things you need to do those things is money. Now, it's often a lot less money than you think is required, but still, you need a little bit of money. So, we're going to talk about investing and growing your money so that when your time is here, you can be ready to go. Leave that job that you've been trying to leave for years and go live your best life wherever that is. First things first, this is not financial advice. I am not telling you what to invest in, and I'm not guaranteeing any financial outcomes. If you want specific financial advice for your situation, you should go to a financial advisor. And I am not one. I'm just someone who did pretty well in investments for myself and retired early. And I have some tips about how I got to where I am right now. Starting your investment journey can be a little scary. So what I want to do in this video is give you some tips that'll make it a little bit easier for you to feel comfortable getting started and investing in your future. After this video, you should be able to take immediate action and start investing today. What we're going to focus on today is opening a starter account. And this is an account that you're going to use to feel comfortable investing in the stock market. So our focus for today, two focuses. First one is small, second is simple. We're going to start small and simple to get you more comfortable investing on your own. The first part of small and simple is figuring out how much money to invest. So what I want you to think about is how much money would you feel comfortable watching grow to something bigger, possibly, but also shriveling to nothing. So what amount of money are you willing to put on the table and risk in order to learn how to use the stock market to grow your money? So what is that? Is it $100? Is it $200, $500? Is it $1,000? What amount of money can you think of investing that is not going to create anxiety? What is the amount that comes to mind that doesn't cause anxiety for you? Because I don't want you to be anxious about this process or it's not going to go well. Now, I mentioned losing your money, but I don't want you to think that's what's going to happen. Historically, the stock market has grown and grown and grown and shown really good returns. I can't say you're going to make money because there are no guarantees in life. But if you look at the historical trends, you're much more likely to gain money in the stock market than lose it. But now, don't get too bold and invest too much, because if the market isn't doing what you want it to do, you're going to get anxious, you're going to get scared, and you're probably going to make pretty bad decisions about the money you've invested. So a number that you're comfortable with, that's where we're starting. Once you figure out the amount you're comfortable investing upfront, now think about another number. And this is the amount of money you're comfortable adding to that initial pile every pay period. $25, $50, $100, $75,000, whatever that number is, adding to your initial sum every week, every month, every 2 weeks is a really good way to use the market and take advantage of those dips that are naturally going to happen. So you should have two pieces of info right now. The first one is how much you're willing to invest upfront in a lump sum. And two is how much money you're willing to invest on a regular basis, whether that's every pay period or some other period that you're comfortable with. The next question is, where are you going to invest? And the answer is with a brokerage. Some of the popular options are Robinhood, TD Ameritrade, Fidelity, Vanguard, which is where I have my money, and there are numerous other ones out there on the market. If one of these sounds good to you already because you've heard about it, someone you know uses it, you're familiar with it for any reason, start there. For the purposes of what we're doing today, it doesn't matter that much. There's one part that matters. We'll get to that in a minute. But overall, most of these brokerages are going to act just like each other. Okay, this is where we're going to get to the differences. Some brokerages require you to have a certain minimum amount to open an account with them. And so you want to know that the brokerage you're looking at is going to allow you to open an account with the amount of money you plan on investing upfront. And now there's a second consideration. A lot of these brokerages have a minimum amount you can invest. Okay, let's back up a second. There are two different minimums, and I want to make sure we're clear on what we're talking about. The first is the minimum amount of money required to open an account with a brokerage. Now, think of that as like money in a shoebox under your bed. Yes, it is somewhere. Yes, it is safe. It is not invested. It is not earning any money. It's just sitting somewhere. That's what happens when you put money into the account and you haven't invested yet. The second is the minimum to invest in funds or ETFs or whatever you're investing in. So that second minimum is the amount of money you need to use to buy, take from a shoebox under the bed, which is the account, and buy different investments. All right, let's go. As an example, Vanguard has no minimum requirement to open an account, but if you want to purchase one of their mutual funds, the minimum is $1,000. Fidelity has at least 4 funds with no minimum requirement for investment. And so they're a good choice if you want to start this sort of practice account with less than $1,000. I'll link to the Fidelity options in the description. Okay, so now to continue this kind of terrible analogy, we're going to talk about what shoes are in the shoebox. I think is probably the best way I can describe that. So you want to invest in an individual brokerage account for this exercise. If you're walking along with me, if you want to get comfortable investing, think about that. We're not talking about 529s, which are education accounts. We're not talking about 401ks or Roth IRAs. We're not talking about anything like that. We are talking about an individual brokerage account because you don't have to wait any amount of time to take your money out of there. If you put your money in tomorrow and you want to take it out the next day, you can. You shouldn't, but you can. So that's a good option for people who want to learn how to invest without committing their money to something that has a little bit more bells and whistles and restrictions on it. We started with small, and now we're moving on to simple as we figure out exactly what to invest in. Well, not exactly, because I'm not going to tell y'all what to invest in because I do not give financial advice, but I'm going to give you some ideas of where to start. Next week, I'm going to publish a video showing you how I figure out what to invest in. But for now, I'm going to say a good idea for most people is to invest in mutual funds and specifically index funds because we're keeping it simple. Index funds are a type of mutual fund that track a market index like the S&P 500. More to come on this in another video. Index funds typically have lower fees and greater returns than a lot of other options on the market. So they're a great choice for people who just want to kind of dip their toe in the water and see if it's right for them. Sticking with the simple theme, plan to hold your investments for a long time. Now, granted, long can mean different things for different people. We will talk about time horizons of investments in the future. But for now, know that the longer you hold, historically, the better your money is going to do and the larger it's going to grow. I asked you earlier how much money you're willing to invest on a regular basis into this account. So this is where we get to this. You want to set up your account so that it takes money, maybe from your checking account or another account, and invests it on a regular period, whether that's once a month, twice a month, every week, whatever that number is that you're comfortable with. And like at least once every 2 weeks. If you were asking for a recommendation is what I would say. But you're not, but you're watching this. So not financial advice. But setting up an account that withdraws money from another source of yours and invests it regularly into a brokerage account is going to help you grow your money and ride out the dips and the hills. It's called dollar cost averaging, and we'll talk about it more later in another video. But this is going to help you kind of smooth out the ups and downs in the market. And speaking of swings in the market and ups and downs, don't check your account on a regular basis. No, think of it as like bread baking in the oven. Close the door. If you keep opening it, nothing good's going to happen. And not that anything bad is happening, right? But the more you check it, the more anxiety it can create for you. I would say that it doesn't really matter what it's doing. This is play money. So if you lose it all, you're comfortable, right? Doesn't really matter what is happening for the first 3 to 6 months. Let it just go. Let it just go. If you want to check it every month, every 2 weeks, fine. But if you do that, you cannot get anxious if you see it go down. That's natural. There are swings in the market. It's up one day, it's down the next. You can't control it. But if you're the kind of person that is going to want to make a change to your portfolio, every time you see it go down, stop looking. Stop looking. Trust that historically the market has done really, really well and grown and grown and grown. And the longer you leave it in, the better it will be for you. So I don't want you to keep checking and feeling like you have to make a change, sell something, buy something else, because that's how you get stuck and not really making progress because you're not letting it just bake. You got to let it just bake and do its thing in the oven. Stop opening the door. So we're not taking our money out of this account. We are going to leave it in for a while, as long as you can. 6 months, a year, 27 years, whatever. Let the money grow. Let it do its thing. Sometime in there, you should feel comfortable with the stock market. What you want to do as this money is doing its thing, you want to educate yourself about different investment opportunities, about different vehicles, different brokerages, figure out a little bit more information based on what you see your money doing. So as you see your money growing or falling, or you look at fees, you're probably going to have questions. So Google is our best friend. And then also all of the brokerage houses have information on their website about what they offer, and education pieces that aren't specifically about their funds, but about educating the investors in general. And that's a really good place to start to get information to figure out what your next step is after this play account. So you have your play account, and next you're going to open a more planned investment, right? It's going to be maybe something you're saving for retirement, maybe for education, something like that. But for now, you have your play account, you're watching it grow, you're putting money in, you're feeling good. You have done it. If you got stuck on what to invest in, I would say, for the most part, it doesn't really matter. Index funds track a sector of the market, and the market, like I said, generally grows and grows and grows. So is there a better option for you than another index fund? Yes, something in there will be better. One of the options will be better than the others. But you know what it's all better than? Leaving your money in the shoebox under your bed or the bank. It's all better than that, right? Investing in the stock market is one of the best ways to grow your money. There is risk, but it's one of the best ways to grow your money. If you're unsure about which index funds to pick and you feel like you need a little bit more advice, first option is Google. You have a very specific question, most likely. Google it. Second, I'm going to release a video next week about how I pick index funds and mutual funds. So if you want to wait around for that before you invest, open an account. Maybe don't invest until you watch the next video, or do it. I recommend you do it because I think that taking action is really the only way to move yourself forward. So take this massive action, invest. If you want to switch what fund it's in later, you can do that. But investing today is a great choice for everyone. Don't forget to subscribe and turn on notifications so you don't miss that next video about how I pick my index funds. Okay, we went through small and we went through simple. So this is a set it and forget it exercise to get you into the stock market. You're dipping your toe in, you're getting started, you're feeling good about progress because there is no perfection, but there is progress. So until next time, wishing you the best. Bye.